Karen, you still think the Fed's behind the curve. The bond market thinks it's going to struggle. Give us your view.
The bond market is basically pricing in a relatively moderate increase in interest rates when you put in perspective just how far inflation has risen. And if you break down the bond market pricing between the real interest rates and the expected inflation, which you can do, of course, with the curve on inflation-linked bonds, you can see that while inflation is expected to be high for the next year or so, maybe two, it's expected to pretty quickly come down afterwards. That's why longer end rates are relatively low. And so more or less, the bond market and the stock market together are pricing, kind of a magical scenario where the Fed tightens not that much. It doesn't kill the expansion because you still have equity prices doing what they're doing, and inflation magically comes down. And if you look at history, that looks pretty unlikely. And it really, to me, echoes of what happened in 1973, when inflation pressures were already the highest had been in a long time. Then you get a big geopolitical shock that's exogenous. And it's just not pleasant to be in the Fed's shoes and tighten into an exogenous supply shock in commodities that has to do with geopolitical events, doesn't have to do with domestic demand. It's just easy to fall behind the curve in that situation when you're reasonably worried about the stagflationary impacts that could happen. But you saw what happened in the 70s. It's very easy to fall behind the curve, and it's a very bad situation for investors.
Karen, I think the equity market anyway, at least my perception of the equity market, is that they're sort of leaning on the employment situation and the steady growth as indicated by employment figures, which is certainly a key characteristic difference between now and 1973, when unemployment peaked or troughed all the way back in '69, when it was on its way up persistently over a period of years into that '73 correction. Can you talk to us a little bit about your outlook for growth and how that's playing into your thesis that this is another 73? Are there key differences that we should be mindful of? And do you see something more nefarious coming for the employment markets?
No, I agree with you. I think growth is incredibly strong and self-sustaining. And really, inflation and how difficult it is to contain inflation is the main parallel. You have a very strong cyclical expansion that at this point is very self-sustaining. It started out getting stimulation from both the Fed and fiscal. But once you get that going and, more income creates more spending, more income creates more spending, it tends to be incredibly self-sustaining. And that's why you see inflationary pressures everywhere. It's very broad. It's not in, one area where there's a particular supply constraint. You see it pretty much in every sector, everywhere you look. And that's why it's going to be so hard to cut it off and probably require a lot more tightening than currently being priced.
Karen, if this is 73, where do I want to be? Where do I not want to be?
Well, the thing you learn is that, nominal bonds are the worst possible thing you can hold, because as inflation keeps picking up, as the Fed needs to tighten into that, the bond market tends to lag that move. That's probably the last thing that you want to hold. Probably the easiest switch to make if you need to hold bonds is to just switch them into inflation-linked bonds, because then you will just get paid whatever CPI prints. And you've seen over the last, a few months already what it's been like to be an inflation-linked bond investor relative to a nominal bond investor. You're getting paid those prints as they're coming in very high. You get paid headline inflation, whatever it prints. In addition to that, most people don't have a lot of commodity exposure. And from my perspective, that is one of the best possible ways to diversify your portfolio, to have a very direct exposure to those supply shocks remaining, to having demand continue to outstrip supply, and to having a squeeze across all the things that we use.
Karen, given your role as co-CIO of sustainability there at Bridgewater, I think we'd be remiss not to leverage your insights on what's going on with the energy materials space, as well as generally sustainable supply chains around the world. Your team's done this great work recently talking about the necessity of governments getting engaged and spending on a transition to cleaner sources of energy. How do you see what's going on in the world right now as either promoting that thesis and really pushing governments in that direction, or potentially even detracting that idea and really pushing it to the back burner as we contend with this crisis?
Well, I think that there's a strong political consensus, especially in Europe, that climate change needs to be curbed, and we need to transition our energy infrastructure and the world's energy base away from where it is today to one that has significantly lower emissions. That said, there are two basic ways to do it, and they make sense. One, you could take all the quote unquote bad things like oil, coal, things that create carbon emissions, and raise their prices, whether that's through carbon pricing, through stopping the supply. The other thing you can do is subsidize the good things, make the renewables cheaper, directly spend fiscal resources on expanding renewable supply. And what was happening ahead of this crisis is a lot of the efforts to curb climate change, where governments were most serious about it, like Europe, were very focused on raising the prices. So carbon pricing, taking coal offline, that sort of thing. Now you get this big shock, and you're basically having energy prices rise in a way that's not that conducive to tackling climate change, because obviously the squeeze on something like natural gas, less bad for the environment, is much less bad and much worse than the squeeze on, say, coal, which is significantly worse. And in my view, the political will to keep tackling climate change through raising energy prices is going to fall. It was already very low. It was impossible to think about carbon pricing in the US. Political will to do it into this environment, it's just not going to make sense to use these inflationary tools of raising energy prices being the way that you try to address climate change. The path to deal with that, and you're seeing Europe already eye at this and start kind of hinting this direction, is to go make renewables cheaper. Go spend, go have big fiscal programs and double, triple your efforts to go get more renewables online faster.
Karen, in 30 seconds, how has the war changed the ESG outlook? What is ESG? Any thoughts on that?
I think that the response you're getting in the private sector, from private sector capital to the war, in terms of the moral outrage from Russia's behavior translating to real action, is way far beyond what anyone had imagined the private sector could do. I think that if we were talking about this before the invasion, we wouldn't even be mentioning things like, is Russia reliant on payments from Visa? What if McDonald's closed all its stores? The response has been swift, it's been rapid, and it's happening at asset owners, it's happening at consumers, it's happening at employees. And to me, this is a new bar of what ESG can be, what it means to have a private sector response. And it's only a matter of time before people say, wait, if you can do this on Russia, why not on climate?